today we're going to be talking about simple approaches to making money with options. And of course, we've already talked a little bit about these in day number 1. And these are covered calls and cash secured puts. So these are really, I would say, primarily the most popular strategies out there for retail. There are people who certainly try their hand at being long options and trying to play the swings in markets and stocks. But predominantly what most people do, certainly people with 9-to-5 jobs who can't watch markets, minute by minute, hour by hour, is they tend to go with an option harvesting strategy. And why is that? Well, quick reminder that we are not investment advisors and that anything we talk about today should not be construed as investment advice of any kind. It is for education, entertainment, and information purposes only. Please do not proceed if you are not in agreement with these conditions. We talked about theta. Being long options involves a negative theta. So you've sort of got this constant erosion that you have to battle. You need to be right. You need to be right relatively soon. And a lot of the time options, as we mentioned, tend to be a little bit overpriced, a little bit expensive versus their underlying movement. Remember, options are like insurance contracts. So you can think of them as sort of an insurance contract on your house. The insurance company tends to sell the insurance for more than it's worth. Now, anything can happen to one individual home. Something disastrous could happen. You're on vacation, the house catches fire. But as they spread these risks over many, many thousands and thousands of homes, they generally know that they're probably going to make money taking in those premiums because they're selling something for $1,000 that might only be worth $800 of risk. Options and volatility in the option space in equities tend to be more expensive than the underlying risk. Not all the time, we've talked about that, it's the volatility risk premium. How much more are people paying for options than they're realistically worth? And it tends to be a little bit more consistently than they're worth. So what we're doing is we're kind of trading this structural edge that we have in markets when we sell options and take advantage of that volatility risk premium over time. So most people like to sell options because of that, because of the fact that they like to just have that money kind of roll in over time, over weekends, overnight while they're sleeping. That really sits well with some people. So covered calls, cash secured puts are really the two primary ways that this is done. There are some variations of this, of course. Other areas, iron condors that we mentioned. We can do spreads, things like that, butterflies, but these tend to be the main ones that most people kind of approach when they get, certainly in the beginning, when they get into options. And I don't think you need to get into anything super complicated beyond these. They're very, very effective for what they're meant to do, which is to basically collect premium. We call it collecting the rents on your portfolio. Let's talk about covered calls. We're going to go back to our friend AMD, the chip maker, and we're going to start looking at what calls we can sell to create our covered call. Now, a covered call can begin with stock that you already own. It might have been in your account for months or years, and you've decided to finally sell a covered call against it. In that case, you would just sell the call that is covered by the stock that you own. We call it covered because when we sell calls against the underlying stock, if the stock moves beyond the strike price, we are obligated to potentially sell that stock to the other side that has bought those calls. If we don't own that stock, we are selling calls that are naked. And I don't suggest selling naked calls unless you're extremely sophisticated in the options trading game. So it's covered because if we own 1,000 shares of AMD and we've sold 10 calls against those 1,000 shares, those options are fully covered by that underlying stock. If we get called away, we have that stock to deliver. So now what we can do is we can sell calls on the partial position. So we might be long 1,000 shares of stock and we might sell 5 calls instead of the full 10. And that's called partial coverage, 50% coverage. So in this case, we're going to do full coverage. So we're going to say that we're going to buy 1,000 shares of AMD right here. And then we're going to look at the different strikes. So again, we have an option chain here that shows us various months that are available to us. We have May options that expire in 1 day, in 8 days, in 15 days. The parentheses here indicate how many days are left in this particular option's lifetime. So we can see these go as far out as 456 days and then even beyond that. We're going to get leaps that actually expire in 946 days. So we're not going to worry about those ones. We're actually going to focus on shorter term options, not super short, but shorter term between 30 and 40 days, because that's when the best theta decay is starting to come in. We don't want to go too short, although a lot of people do like to sell weeklies to grab that super steep theta decay period. But in my view, you have a little bit of short gamma in that case, which we're going to talk about at a different time. I prefer to try to capture that sort of 20 to 40 day option premium decay. So we're going to look at June's, which are 36 days away. Perfect. And we can see that the calls are all on the left side, the puts are on the right side. We've got the strikes down the middle here. We've got strikes of 5, 10, 15, 20. So we have very, very low strikes that have probably been listed for a very long time when the stock was lower, because the strikes tend to get listed around where the stock is trading. We have the 165 strike, which is roughly where the stock is trading. It's trading at 162.62. So we have strikes that are right around where that stock is trading, and those are the ones we're going to focus on today. So the ones expiring in 36 days on June 21st, the calls are listed here, and we can see the deltas. Remember, we're always going back to our friend delta. We can see we have a 49 delta, which makes sense. That's about right at the money, has about a 49% chance of being in the money by expiry. So by expiry in 36 days from now. This has a 49% chance of being in the money, which makes sense. It's right around where the stock is trading, like a coin flip, 50-50. The next ones, the 170s, are a 40 delta. The next ones are the 175s. They're a 32 delta. The next ones are the 180 strike. Those are a 25 delta. Again, 25, meaning roughly that these options have about a 25% chance of being in the money on expiry. As we go out and out, we can see a one standard deviation is around a 16 delta, so somewhere between the 14 and the 19 delta here. When you hear people talk about expected range, that is a one standard deviation move that tends to be around the 15 or 16 delta. So we're going to pick the 25 delta call to sell. Now I like the 25 delta. It's not quite a full standard deviation, but if you go out too far, you're starting to get anemic premiums, right? There's a much higher probability that these are going to expire worthless. But I like to get a little bit of extra juice when I'm selling these calls. So if I sell the 180 for 281, I have a covered call. I'm long 1,000 shares at 162.18, and I'm short 10 of the June 21st 180 strike calls, which I've sold for 281. So let's see what this looks like in our risk profile. We've now created a position that looks like this. So we have the zero line right here, and we have our familiar expiry line in the light blue, and we have the kind of pink purple line, which is our real-time P&L. But let's focus on the expiry line. So let's say nothing happens for the next 30 days. The stock doesn't move at all. Well, what's going to happen? The stock is right here at about 162, and it's going to show us that we're going to make about $2,800 because we've sold 10 of these at 281. So we're going to receive $2,810 in premium. We're not talking about any transaction costs at all. We're going to receive $2,810 for having sold that. Why is that? Because 10 contracts times 281 times 100 shares, because each contract is going to denote 100 shares. So we're receiving $2,810. And if nothing happens, we're going to receive that money. And we can see that right here. We see the little blue numbers down here. We're going to tell us what we're making on expiry. There's our $2,800. So now what happens if the stock goes up? So we're going to move this over a little bit. If the stock goes up, we are going to be able to make money on the stock until we hit the strike of 180. So the nice thing about selling an out of the money call is it's bullish and is going to benefit from an upward rise in the stock up to a certain point. Now, some people feel that covered calls are either bearish or neutral, and they're not interested in doing them unless they feel that markets aren't going to do anything. But I hope this makes it clear that you can actually do quite well up to the strike price. So AMD can go from 162 all the way to 180 before we are capped by our covered call. Beyond 180, of course, we're obligated to sell our stock. And for the value that we've brought in, that $2.81 of premium, we have to agree to give up any more upside beyond 180. But even at 180, our break even is a little better than that because we're able to make money from 162 all the way to 180. But in addition, we receive $2.81. So our break even is actually 182.81. 182.81 is our break even. And that's really great. So that's a pretty good number for 1 month of movement. We've taken in $2.81, which is a very nice premium versus the underlying value of 162. And in addition, if the stock does move up, we're able to enjoy the capital gains in the underlying stock itself. So all in all, we're able to do very, very well if the stock goes to this ideal price of 180 because we've made the $18 all the way to 180 plus that $2.81. So we can see here that our best case scenario is the stock moving to 180 plus we've made our $2.81 and we've done very, very well on our 1,000 shares in our covered call. So mission accomplished on this particular covered call. Now what happens if things don't go quite the same way? Let's say things move down. Well, what happens? We're going to start losing money on our 1,000 shares, right? And that's simple. We know the linear relationship on long stock. We know exactly what we're going to lose on that particular stock. But we've taken in $2.81 for that call that we've sold. So effectively, that's going to lower our cost basis from 162 down to about 159, right? So our cost basis actually comes down to about 159.20 because the 281 is now in our account. That money shows up. And so our break even is actually this new lower price of 159 and a little bit. We can consider that a little bit of a hedge. And now when we do this over time, so what covered call sellers do is they do this on a monthly basis, sometimes on a weekly basis, sometimes every 2 weeks. And you do this repeatedly over time. And these premiums can add up to a relatively decent hedge over time. So in markets where things are sort of falling and we're restriking each month, we're losing on our underlying position, but we're collecting those premiums. So sometimes it's in the negative and more bearish markets that we see some of this benefit when we outperform holding the stock on its own because we keep taking in these premiums week after week or month after month. And those can tend to add up over time, particularly when markets are really, really struggling and option prices tend to go up. Now you're getting even more for those calls. So there's a relationship, a correlation between fear and markets going down and better option premiums. Now, as we go below that break-even price, we are going to now basically lose money along with the stock because the cushion that we've been given, the $2.81, is only going to last so long. Now, what we can do is something called a roll down. So we can buy back this call at perhaps 30, 40 cents, 20 cents, and then sell a new call. So if we're particularly bearish on this, or we feel like the market is suddenly in a kind of more bearish environment, again, this is something that we do in the Cash Flow Insider system. We're constantly evaluating the market, and the market can go from a green to a yellow and hedge to a red, which is get worried and start to hedge more aggressively. And we do certain things under those conditions that help to protect our portfolio a little bit more. But if we're in a yellow kind of environment, which is very cautious, we're going to start being more aggressive. We're going to roll down. We're going to take in extra premiums. We're going to look for bounces back on the chart to perhaps the 9-day or the 20-day moving average, and we're going to react to that with our hedging program. So that kind of gives you an idea of how things work with a covered call. We've got the benefit to the upside. We've got the capped performance beyond a certain point. We've got a little bit of a hedge and a cushion to the downside. And then beyond that, we start to follow along with the stock to the downside. But again, we can roll down that position, roll down and out. What we mean by that is down to a lower strike because the stock has dropped, and out, which means to the next month or perhaps a couple of weeks later. So rolling out means buying back a call and then selling another call that is perhaps 2 or 3 weeks longer in duration. So we might sell in April, we buy that back, and we sell in May. When we buy back the May, we sell in June, and so on and so forth. Now let's talk about the put sale, a cash secured put sale. So we talked about how when we're long the stock, we're covered for the call that we've sold. So we're covered just in case that stock continues up. So if we continue up and our performance is capped because we are obligated to sell this stock at the strike price, if we don't own that stock, then we're naked long that call. And we have a technically unlimited risk because this particular stock could go to 10,000 for all we know. It's not going to go there, but it could go to 200, 300, 400. If it's like one of these meme stocks, it could go to multiple of hundreds. And we don't have the stock to cover that short call position. And that could get very, very expensive and could be very detrimental to your account. So you want to be covered. You don't want to sell more calls than you have stock. You don't want to sell 20 calls when you're long 1,000 shares of stock, because that means you have 10 calls that are uncovered. You're going to be short 1,000 shares from here to eternity, and that's a very dangerous thing to do. Now, when we talk about put selling, it's a slightly different concept. You're not talking about a covered call where you need to own the stock. With puts, you're going to sell a downside put, but you're going to be covered by cash, right? So cash is what's going to turn this into a cash secured put sale, a cash secured put. And what that means is this. We're going to go back into the market for AMD and recall that the calls are on the left, puts are on the right, the strikes are down the middle, the month is down the middle, right? Because we're trading June 21st, 2024 options. And we're going to say, well, you know what? I think AMD at 162 is a little pricey for me. I think it's had a little bit of a run up. It used to trade at $90. I'm a little uncomfortable buying it here, but I wouldn't mind buying it a little bit lower. In fact, I wouldn't mind buying it at 150. What I can do is I can sell the 273 value option put that has a 150 strike. So the 150 strike put is trading at $2.73, and I can sell that put and receive $2,730 for the 1,000 shares equivalent that I've sold. So when I sell, each contract gives me 100 shares. Each contract would be $273. I've sold 10 contracts, and that equates to $2,730. So what am I saying here when I do this? When I sell this put, first of all, it's cash secured. So that means I have the full amount of cash that is going to secure this. If AMD were to go to zero, it's going to require me to have $150,000 here, right? Less the premium that I've sold. So I need to have about $150,000 in my account to fully cover this. Now, if you have a margin account, it's a little bit different. It's going to charge you margin, which is quite a bit less than that. But cash secured generally means that I have the full amount in case the stock drops below $150 and I get the stock put to me. So recall that when you are short a put, you're obligated to buy that stock at that particular price by the date of expiry, right? And so calls and puts can be exercised at any time when they're American style. When they're European style, it's a little bit different. They tend to be cash settled, etc. We're not going to worry about those, tend to be index options. But with stocks, we tend to have American style options that are settled with the underlying stock. So what this means is, even though AMD is trading at 162, I'm saying that if it drops below $150, I'm willing to buy it there. And if it closes under $150 on expiry, I am going to buy it there. So I need to be prepared for that and have the funds available for that. But in the meantime, to give somebody the right to buy that stock from me at $150, or rather to sell it to me at $150, I'm going to receive $2.73 of premium, or $2,730. Let's take a look at how that looks. Here we go. We can see that above $150, our expiry line shows us that we've made the $2,700 and $2,730 that we have received because the stock didn't drop below $150. Well, what happens if the stock does drop below $150? Well, we start to give some of that back. Where's our break even? We're going to have to buy stock at $150. But our break even is actually $2.73 lower than that because we've received $2.73 for that option. So we are buying stock at $150, but our cost basis is going to actually be $2.73 lower than that because we received that extra $2.73. Now, beyond that, we are long the stock, right? So the thing to keep in mind with selling puts is there's always the possibility that you're going to own this particular company. So what I like to tell students is that you want to sell puts on stocks that you like, right? Because inevitably, you're going to end up owning some of these positions. We just can't be that good that we're never, ever going to get run over on our strike and end up owning that particular option. Unless you're very, very good at stick handling and taking losses on these positions and being very, very proactive. Generally speaking, though, eventually you're going to get a stock that gaps down through the strike price. You're going to end up owning the stock. So I like to stay away from companies that are of a low quality or very, very speculative nature. And that's hard to do because those are the companies that give you the really, really, really juicy premiums. So you could be looking at a very speculative name versus a quality name, like say a Microsoft would be quality. You might be looking at a speculative name that is going to give you about $5 for that put. Microsoft might only give you $2 for that put. You're going to say, wow, I'd rather get $5 for a similarly out of the money put. But you have to be prepared that that $5 reflects a stock that is going to be more volatile in nature than a Microsoft. Those option premiums are going to reflect the higher volatility in that particular stock, which you might be okay with. And I'm not saying you don't want to own that particular stock, but you need to keep in mind that the higher the premium, the more volatile that stock tends to be. And the possibility that the stock is of a lower quality, perhaps a stock that doesn't have any profits, that is early stage in its growth and things like that, is a very real thing. So we have to always balance our ideas with, hey, listen, we're going to be selling puts and calls on stocks. We want them to be of a minimum quality because in the end, we just own them. If we're short a call and the stock goes down, well, basically we're just long the stock in a covered call. If we're short a put and the stock goes down, we may end up owning that stock. So in both situations, whether it's a covered call or a short put, we're going to potentially end up owning this stock if it goes down enough. And we're no longer protected by that sort of cushion that we get from selling the options. So we need to be aware of the quality of the names that we're doing this on. So again, to the upside, when we're selling a put, the most we're ever going to make is that $2.73 that we've received for the option. So we can see that we are maxed out at our $2,730 profit. Down below 150, we start to give some of that back and give some of that back, and our break even, of course, is 150 minus the 273, and that is 147.27. So our break even is 147.27, and beyond that, we have a bit of a problem because we're now long stock. But originally, when we came up with this idea, we said, well, I wouldn't mind owning AMD at 150. I don't like it at 162. So I'm going to get paid for the possibility that I might end up owning it. And if it doesn't drop there, I'm going to collect that $2.73. So if AMD just sort of sits around, goes to 155, goes to 160, sits around 157, for example, the stock has come down. I haven't bought it because it didn't drop through the strike price, but I've collected my $2.73. So what I do is I do it again. Next month we do it again. If this was an April call, we sell the May. If this was a June call, next month we sell the July, and so on and so forth, rinse and repeat. And that's how the short put works. Now, a short put is basically a covered call. They look effectively the same, but they're just different structures, right? A long stock short call structure is going to look very similar to a short put structure. A covered call is a synthetic short put. A lot of people don't realize that. But effectively, you can think about it intuitively. In both scenarios, you own the stock if it goes down enough. And if the stock goes up, in both scenarios, you're capped. You're capped by the premium you've taken in on your short put, or you're capped by the cover call that you've sold against your stock. So similar sort of concept there, two ways of attacking it. One of the benefits to selling puts is you often get that put skew. We talked about that in the first lesson. You get that steep skew that is going to pay you a little bit more implied volatility for having sold that out of the money put. And that can tend to be a very real benefit over time when selling puts versus selling calls, when selling out of the money puts versus selling out of the money calls. Upside call skew tends to get compressed because of covered call funds that are consistently selling those calls. And the fact that downside puts tend to be more expensive because markets tend to crash down instead of crash up. So people price those puts more aggressively and more expensively. So hopefully that gives you an idea of how covered calls and cash secured puts work a little bit more. And we'll see you guys in the next lesson.